In this video, I will talk about specific macro data points concerning equities and the economic cycle. And before I share all of these data points with you, I want to mention that I also made a video about cryptocurrency and the altcoin markets, where I share my cycle targets and much more. Let's dive into the content because I have a lot to share with you. The first part what I want to talk about is the current sentiment, because sentiment is a big driver in markets. As you may or may not know, sentiment tends to move up or down in one specific cycle many times, but eventually that sentiment gets to an extreme. That extreme is what we call extreme fear, as we have seen in 2022, where everyone is on the same side, everyone was expecting a recession, where I made the call that sentiment is so bad, we were actually going to go up a lot, which we did. 2 years later, right now, I am starting to see the actual opposite. We are starting to see what is called real euphoria. And we are seeing many articles which are concerning and which are probably aligning with that greedy, with that euphoria last move, last stage of the cycle emotionally. So what we have seen 2 weeks ago from BlackRock is the world economy has exited the boom and bust cycle. And the NBC News also mentions meme coins like Fartcoin are riding Trump's victory to huge valuations. Fartcoin made it to roughly 700 or 800 million market cap. And these are specific targets which we tend to see near cycle highs. As we also see near cycle lows, very pessimistic articles arise. It is concerning that we are seeing comments like this rise again. We also see the actual ECB or a Federal Reserve people speaking out that we are in a healthy economy, we are strong, we will not move into recession, and that is often what occurs right before a downturn. As you can see, two examples which I would like to share is that in March of 2000, right before the actual .com bubble burst, that we saw similar articles like the boom and bust is at an end. And we also saw the same before the Big Depression in America. Fisher sees stocks permanently high, and this is basically from October 1929. So what we tend to see is that sentiment is very positive near a cycle high. There is no reason to see a downfall. Things look amazing and people move into euphoria because we are moving higher. We are seeing the same today. People are talking about artificial intelligence. People are talking about all sorts of stuff and why tech will continue to go up while we are at big extremes. And let's talk about other sentiment indicators. First, when we look at the left top, we see the AAIE sentiment, and the annual high was 53%. We are not there just yet, so we're not at a very extreme, but we see that considering the average of 38%, we are trending above that. So bulls are in charge, sentiment is very bullish, and we see that also on the fear and greed index, which is showing greed. We are not at extreme fear, but we are elevated for a very long time. We see the same in the NAIM, which is showing a high number as well. And the last time that we moved to such numbers, you can see there was almost always, besides the start of 2024, a slight market correction. We are elevated once again, and we see that overall sentiment is getting very euphoric. When we look at Google Trends, we look for recession, then we see two spikes. For the rest, not a lot of interest. We are hovering around the 25 level. When we do the same for like soft landing, we can see it stays elevated and it stays quite a lot higher than recession. When we look at no landing, it is hovering around 75. So the sentiment of the people is there is no recession coming, things are good, we are recovering, equities are at all-time high, we are going for a full soft landing as the rate cuts from the Fed are coming in, supporting the markets. That is the actual narrative right now. Individual investors also are not very concerned about a stock market crash at the same level that we have also seen in 2008. So we are seeing the soft land narrative in full motion. Now I want to give a small update because I started making this video and we also had our FOMC, and we can see that post FOMC today at Friday the 20th of December, markets are however retracing. We do see 5 to 6, 7% corrections on the run up. I do not see this as a potential big problem just yet. So market corrections do occur, and because of the FOMC statement, which was very hawkish by Jerome Powell, people are becoming fearful after that, and yesterday and today as well. We see that the same sentiment that used to be greed at the start of the presentation already resets to extreme fear. I wanted to include this update because that clearly shows that we go from greed to fear in a heartbeat, and people have no conviction. And this is typical because at every cyclical peak, we see volatility increase, and we also see more nervousness. And this is already being reflected in the sentiment. We are elevated quite a lot, and when something happens, people really get nervous very fast, and we shake around. So sentiment-wise, I think we are going towards a kind of peak event. We are not at the biggest extreme, but we are certainly elevated. And we are really noticing that people are jumping on the bandwagon once again. People are becoming a lot more heavily bullish. Let's take a look at a very important metric for the Fed. They base their rate cuts on two things, and that is first inflation and secondly jobs. And they look at current inflation data as their driver, so looking at what is happening with inflation is of importance for every investor, because that could drive liquidity either way. If we look at Trueflation, which is a very accurate inflation index, which I really like, then you can see we moved from roughly 12% all the way to 1.2%. I have been talking about massive deflationary pressures coming, and we have seen that initial push. Now, since roughly November, we have been trending back up and we are sitting around 3%. And I think it's normal for trends to take a pause, or perhaps are even witnessing our current inflation bottom. We have to wait a little bit more for that to develop. It's too early to make a call either way, but we have been trending down massively. Inflation is no problem no more. And as you can see, after our peak, and this is the official CPI numbers, we had which is called an inflation pause, and we have broken lower, and we are currently still moving lower. And while we may see a resurgence of inflation as we have seen in the last 2 or 3 months, we are still trending very low. So keep in mind that we are not in a danger zone, or that calling inflation to run back up just when it made only a slight high is prematurely. We are trending lower, and we are still trending in a bearish trend. PCE also moved down very much. PCE is actually the preferable measurement which the Fed likes to track for inflation. And today data came out which was plus 0.1, expectations were 0.2. So it actually came out pretty soft, which is bullish. And generally what we can see is the same as with inflation. Targets have been moving down significantly, but we see that the last 5 to 6 months, we see a bottoming occur. Are we seeing a pause and then a continuation, or are we forming a bottom? We will have to track, but still inflation is not really any concern right now. One of the big things holding CPI up is shelter. If we look at shelter and we actually replace the lagging indicator by a real-time shelter indicator, it doesn't matter which formula that we like to use, then real CPI should be well below 2%. And that is actually contrary to what people and professionals are saying, because they are saying inflation is running hot. And that is because shelter has a massive lag. It has peaked and it has been moving down, but the CPI basket continuously changes and is lagging behind very much. And it's actually a very useless method of measuring real inflation in the economy. Now, the second metric which is holding up the CPI is auto insurance, and it is also moving down. But just looking at the biggest contributor, which is still shelter, it has been elevating CPI already for 12 to 18 months. There is no inflation problem. As you can see here, once again, we see apartment listings as well. And then we see the CPI shelter component. And then we can clearly see that we are, and my head is in front of it, but we are at levels lower than 2020. So we are already past that number, let's say, and you can clearly see that shelter CPI is lagging behind very much, is now trending lower and is expected to go back to its lows, but it is still taking a long time. So while many people are calling for a resurgence of inflation, I am really not concerned about inflation, and on the contrary, I think that deflationary pressures are a bigger issue than increased inflation, at least in the next 12 to 18 months. Because yeah, I think that if we look at some non-lagging indications, inflation is already quite under control. Another part which I want to share is longer term though. So while I still say inflation is not a problem right now, the CPI basket is lagging. This is because of auto insurance and because of shelter. Still in the long term, there is a massive lag how the Fed prints and retracts liquidity out of the system. And that is causing inflation. And because they are working with lagging indicators, I do believe that we are similarly moving as we have been in the 70s, which means that inflation never comes in one wave alone, but inflation is hard to tame and often sees a second wave. Considering that we are in a fiscal dominant environment, deficit spending for the US is high. I do think that these will be pressures and they will eventually print a lot more money, which is called quantitative easing, and that will put us in a new inflation cycle. That won't be for the next 12 months, but I do see another surge up in inflation. Now, will it be higher or will it go to the same levels or slightly lower? I do not know, but I do expect moving into 2030 that we will move on this trajectory and that we will not only have seen one cycle, but that we will see a resurgence before 2030 in inflation. Another metric that the Fed likes to track in order to see how healthy the economy is unemployment. And the first chart I want to look at is continued jobless claims, job openings, and the unemployment rate. I have been saying before that the unemployment rate is moving up, and that is very concerning. And while we see monetary lags, eventually those lags play out, and then employment, or better said, unemployment starts going up, which we are currently seeing. So what do we also see? We see that job openings tend to move down, jobless claims move up, and with that, unemployment moves up as well. Here we see the same. As soon as it turns the trend here, we see a spike in unemployment. Very often when we see a spike, the economy is not doing well. We see what is called a recession, or at least big issues in the economy and big price corrections at the very least. What are we seeing right now? Job openings moving down back at 2018 levels, moving down quite a lot. Jobless claims moving up. And with that, the unemployment level also moving up. It has not accelerated massively, but it is increasing towards a level which is concerning very soon. Another interesting mention from the Kobesi letter is that it doesn't add up what the government is reporting. The US has added 227,000 jobs, while on the flip side, some jobs were lost as well. generally, they are seeing that 1.7 million people in the long term are unemployed, which is up from 1.2 million last year. All while the US added 33k jobs last month alone. Something does not add up. And we see both part-time employment, which is blue, and full-time employment trending down. We are seeing more weakness overall, in my opinion. And let's not only talk about revisions. Because if they do revisions, we know a while ago, a big revision, a big miss of over 25% of over-reported jobs, which means that many more people were actually not employed. And I think we will see more of that later on as the Trump administration takes over. We will see. I think jobs are weakening. I think the trend is moving down, and I do not think it is healthy. I think it's very concerning. Let's look at the consumer, because we can talk about jobs and inflation, but the consumer is also a big part of the economy. And when we look at the left, we see retail sales going up, but adjusted for inflation, retail sales are flat and slightly down. That is actually not a strong economic picture on itself. When we look at personal savings, we have been trending down and slightly flat though, but we have not really seen a recovery since the Corona handouts money. We see the same for household savings. They have been moving down since Corona. And we also see the same for delinquency rates on credit card loans. They have been moving up. My hair is in the way once again. But they have been moving up, as you can see, massively. If we look at total outstanding credits, they are to a new all-time high, which is also concerning because people are buying even groceries on credit, and that's only a part of the economy, but it's still concerning. We see household debt in general at a new high, which is also not a healthy picture. So I reported about consumer weakness before. I'm not seeing improvements. I'm only seeing weakening. There are consumers which are already have a house, which are probably making money on that. There are consumers that have equities, and obviously the equity market have been doing well. So there is a wealth effect for those invested. But I also see a lot of weakness overall. So I wouldn't really say that the consumer is strengthening. I would really think that they are actually weakening very much.